Nice to see the other side of the room. I've been sitting over here and to see some faces on this side. Yeah, I feel that I've kind of parachuted into this particular network. Actually, I feel like Brian pushed me out of the plane. And but I very much appreciate it, Brian, that you did push me out, because this has been really interesting for me. And I hope I'm going to have something to say that's relevant. Certainly, I think I have something to say about resilience. I'm not so sure I have a lot to say about networks, but maybe this will inspire some joint work, and maybe next year at this meeting I'll have more to say on this topic about networks. Yeah, where did I parachute in from? Well, I've been doing work over the last few years at IIASA looking at climate change issues, specifically extreme events, and I'm very grateful that John has brought up the topic of extreme events. But contrary to John, we are dealing with hurricanes and windstorms and floods and droughts, because that's what seems to be possibly worsening because of climate change. And our focus has been on adaptation, and especially in developing and emerging economy countries. So the examples I'm going to bring today will be from that part of the world. I know that, well, my title, Global Networks for Insuring Catastrophic Risks, it probably should have been for financing catastrophic risks, because I'm going to talk more than just about insurance. But the global change community, or the climate change community, particularly in the negotiations, has been particularly interested in insurance as an adaptation measure. So I've kind of got my head stuck on insurance, but we cover a much broader range of financial instruments. And obviously the idea of financial instruments in global networks can be very bad news, as we have seen recently with the financial crisis. And I hope that through this discussion, it'll be more of a potentially good news story in building resilience in the poorer countries against the extreme events from climate change. Before I go to my outline, I'll just jump right into a recent example to kind of give you a little bit of an idea. Recently, a few years ago actually, the Mexican government issued a cat bond. And we worked with them actually in issuing this, and it was very, very novel. For one, cat bonds were very novel and had only been used by insurers to actually kind of reinsure themselves. And this was the first time a government had done it. Now, what is a cat bond? Well, this was a cat bond to protect the Mexican government's catastrophe fund, reserve fund, where they had a certain amount of money if it isn't robbed by whatever political party is in power, but it should have a certain amount of money in it. And they figured, through doing some assessments that we also were a part of, they figured that it wasn't enough if they had a major hurricane or a major earthquake. And so they decided, rather than increase taxes, that they would hedge it. They would, in fact, issue a bond where if you bought the bond, you would get above market rate of interest if nothing happened over the next 12 months, meaning the nothing would be defined by some physical trigger, like a hurricane of a certain magnitude in a certain area. And the contract would get defined like that. And if that hurricane did happen, you would get a lot less, and you might even lose principal. And the Mexican government would benefit from that and use that money to repair its infrastructure and help its needy population after the hurricane. So this was a first. It was successful, and they've actually have continued issuing cat bonds every year as this novel instrument. So my talk is going to address, our risk transfer instruments, for example, cat bonds, but also the Mexican government also, by the way, just bought plain old reinsurance as a part of this deal. Is this advisable? Is this a good idea? Could we recommend it to poorer countries? Do they increase resilience? Let's face it, they cost a lot of money. So something goes down, whereas the security goes up, and is it worth it? What kinds of networks are necessary if these kinds of financial instruments would be used in the poorer countries? That's really been our focus. So I'm trying to make a network. Let's think about Mexico, or let's think about any country. A disaster strikes, there's a great deal of infrastructure loss. By the way, infrastructure loss is extraordinarily interesting for the developing worlds, for disasters, because the overwhelming mark of their capital is public capital. They don't have a lot of private capital. There's not a lot of laptops and cars and garages and things like that. But there are schools, there's roads and so on, which is really the basis of their economy. So infrastructure loss is the name of the game in these countries for disasters. And of course you get the loss in electricity, transport, schools, et cetera, and that, of course, you can build great networks on how that cascades out and what the impacts are. There was relating this back, of course, to our earlier talks. I mean, this is really the what do you call it? In the lazy eight, of course, this is the destructive part of the cycle. And of course, there has been work, and we've done work on, does the idea of creative destruction actually hold with disasters? Will these countries come back actually in a better place? And there's reasons to think they could, because they replace old capital with new innovative capital, and they could come back in a better place. And actually, the results are still out on that. We've shown that for very large disasters in very poor countries, no, they can. Let's take Haiti as an example, or let's take Honduras with Hurricane Mitch. In Honduras, we've done work there. They are still not back to a kind of a growth trajectory that would have been predicted had that disaster not happened. I think that's resilience, how much a country can come back to some kind of normalcy after disaster. I suspect Haiti is not very resilient. I suspect Mexico is probably much more resilient. And so that's the kind of thing we're talking about here. And so we're talking about how do we, in fact, build resilience in these countries. Okay, so on top of this network on physical destruction, we've also got a kind of network on how you finance the repair of that construction and get yourself back to where you were, or back to someplace. And so here we're looking at not the disaster, but the government liabilities from that disaster. And what do governments do when disasters happen, particularly in poor countries? Well, the first thing they do is they divert from other things they were going to spend their money on. So they take it away from the schools they were going to build, from all that. Then they borrow. These are countries without reserve funds, or insufficient reserve funds. They borrow. They seldom raise taxes. Australia just did after the big floods. But developing countries, usually the tax base is already pretty much exhausted. It's very hard to raise taxes. And they depend a lot on aid. Now, the interesting thing, and what we've really been interested in, is first, all of these financial instruments, these post-disaster instruments, have impacts in themselves, but also they're also often not often, but enough times, they're not enough. That you can have countries that can't beg, borrow, or steal enough after a disaster to really have the capital they need to restore. I mean, Haiti, I think, is a good example. Despite all of the promises of aid that usually it's only promises, it doesn't come through, a lot of it. These countries, after disasters, nobody will loan to them. Their credit rating goes to the bottom. So they can't borrow, their tax base is exhausted. The aid that's being promised, we've done a lot of studies on that, maybe 20% of it actually comes in. And how much can they divert from their budgets? So they're, maybe it's an extreme phrase, but they're kind of bankrupt. They can't recover. They're not resilient. So we call this kind of the losses minus how much they can find in money. We call that the gap. And I'm back to John's presentation. The gap, in this case, and I perfectly agree with you, resilience to what? Well, the resilience to recovering from a disaster, and there's a gap, and I would call that, that would be maybe a definition of resilience, financial resilience. We've tried to model that by looking at, trying to go into these countries and look at the trying to build a kind of what they call a probability exceedance, loss exceedance curve in that country. And I know we had discussions on data and so on, and actually estimating risks from extremes, and we know that that's very shaky business, but we do it. It sells. No, it's important, I think, to do it. Just the fact of doing it actually gives you a lot of insights on your risk profile. And we can look at the budgets of those countries and see, you know, how much they could expect if the disaster happened today, how much they could expect to have in capital to finance it. And then we can calculate whether there's a gap or not. And we have done that for a number of countries. In fact, we have done that for every country across the world, for those we could find enough data on. And this we did for the World Development Report. And we showed at what kind of event there would be a gap. And so this is kind of a map of resilience, financial resilience across the world, where the blue countries look pretty resilient and the red countries look pretty unresilient, and we have all those shades in between. Of course, you all know who've done modeling, there's lots of uncertainties around this, but it gives you a little bit of a feel for this. The gray countries, by the way, are unfortunately those that we didn't have data on. So if we zero into one of these red countries, I will, which is Madagascar, just give you an idea of what this modeling looks like. Here we have on the x-axis we have the return event, you know, the size, that's usually the size of the event, and then we have the losses on the vertical axis. And we can plot across there what that government can bring in terms of funding. And when it reaches a point where it cannot fund the losses, then we have the gap, what you see there in the purple, at about here, about the 60-year event. Now, what can Madagascar do? And we do a lot of this. We actually consult these countries on what they can do if they want to reduce the probability of having a gap, which is extraordinarily serious for them, by the way. You know, so that's not just on paper. It is a very disastrous situation for a country to be in. And so what can they do to reduce the probability of that gap? Well, then we try to think about some pre-disaster arrangements. So instead of relying on the post-disaster financing arrangements, we say, well, should they increase their reserve or build one if they don't have one? What about cat bonds, which I mentioned that actually Mexico did? What about reinsurance? What about contingent credit arrangements, which actually the World Bank makes for these countries? And I could go on. There's other instruments. The idea is that they can push these losses kind of into the global community. Now, this is interesting to me. If you look at kind of the annual losses from disasters, especially in the developing country, if you take out the developed world, actually it's not that large. And it's easily absorbable into the global capital markets. It's just, the global capital markets go up much more down every few months than any of these disasters cause. It's really nothing if you really can spread these into the investors. Of course, that costs money. Investors don't take on these risks for nothing. So one of the things we've been really interested in is how do you get help to these countries? We say that this is a way that actually, and this is what we put into the negotiating text for the climate negotiations, could you build regional facilities that would, in fact, provide support for these instruments to these countries as a very concrete way of helping them to adapt? And in fact, that has text, of course, in Copenhagen, got nowhere, but there are a lot of institutions taking us up on this. In fact, the World Food Program, which has to go in these countries and provide assistance, food assistance, and also faces gaps and worries about its financial solubility in the face of disasters. It actually helped Ethiopian government issue a cat bond very recently. And so you're starting to see this move into the development community and also into the climate change community as a very real way of helping these countries. How do I look for time? 5 minutes, okay. So I just wanted to move from the public sector to the private sector and just give a quick example. It's a very similar story, but I'm going from the government level down to the household level or the farm level. And this is a system, a pilot insurance system that has recently been put into effect in Malawi by the World Bank. And the World Bank actually asked us, as kind of independent people, to go down and evaluate it. And it's really very interesting. Malawi has a very good network of weather stations and good historical data on the weather. And so the bank has constructed a kind of risk profile for farmers based on rainfall, and could design a product that is index-based, very much like the cat bond. If the rain falls below a certain level at a certain time of the planting season, the farmer gets a payout no matter what happens to the farmer's crops. Now, this is really good because traditional agricultural insurance has actually been, in the developing world, a total failure. Why? Because the transaction costs are so high. Going out and assessing Mr. X's losses after disaster costs a lot of money. You eliminate the transaction costs and you eliminate moral hazard because the farmer has every incentive to not lose his crops and still get the payout. Yeah? So it's kind of a very interesting idea, and it was set up in Malawi for farmers living within a certain radius of the weather stations. There's lots of problems with it, and I don't have time to go through with the problems, but the upside of it is that it works. It made farmers much more creditworthy so that they could buy the inputs. Jan was talking about that the farmers can't even buy the fertilizer. They couldn't either. These are really poor farmers. But the bank, if they have this insurance in hand, the bank will actually loan them money so they can buy the inputs they need, makes them a great deal more productive. Promoters claims it moves away the big rocks, systemic drought risks, and enables development. Supported both by the World Food Program and the World Bank. Okay, so back to this, the household in Malawi, what do they do if there's a drought and they lose their crops? Well, what do they do? Well, first off, they often sell the goat. Yeah, they got to survive, so they sell their assets. They borrow, sometimes from money lenders. That can be very good. There's actually really good money lenders. It can also be very bad. They take their children out of school and put them to work. Of course, they adopt other livelihood strategies and so on, and they get very dependent on very ad hoc aid. If you're a mother in Malawi, I think you would feel a lot more secure having a contract that you could trust, that you would have some money after a drought, than having to rely on ad hoc aid and the possibility your children might really starve. I mean, this is really existential for them. So, so the idea of putting into place secure contracts is very appealing. And so, okay, what can they do before disasters? Well, one, they're pretty darn clever. They do put in a lot of pre-disaster arrangements. They send one of their children to London to work, and get remittances. They make mutual arrangements. They have very formal ways of making mutual arrangements with people outside of the radius where they would be also affected by the disasters they suffer from. Of course, they save and all that sort of thing. And as we saw in Malawi, they are keenly interested in insurance contracts, which indeed pushes these risks again into the global markets because the insurers have to reinsure and so on and so forth. But Malawi farmers hardly can afford this, to be honest. They can afford it to cover a small part of their losses, to really cover what they need to cover and get the safety nets in place. By the way, they can't rely at all on their government. So to get the safety nets in place, you really need these global networks. And they're being fulfilled. The networks are forming. NGOs are extraordinarily important in these pilots. By the way, the pilot in Malawi has spread. It's now lots of them. Reinsurance is extraordinarily important, and providing the capital to the local backups, the capital backups to the local insurers. And we're finding that the World Bank and other international financial institutions are starting to actually do that. In fact, some people are calling it World Bank RE. There's alternative risk transfer systems, as we saw from Mexico, that are very interesting. I already talked about the IFIs, and as I already talked about before, the potential that the climate change community might take this up by actually subsidizing these systems or capitalizing these systems. I'm going to end there because he's put up the sign end, and I didn't want anyway to show my last slide. So I'll just end. Thank you.